right. Hello, everybody. Steve Rose, wealth advisor, founder of Art of Wealth Management, here again with my good friend Ryan Detrick, who is chief market strategist of the Carson Group. So, Ryan, thank you so much for your time today.
Steve, thanks for having me. And I'm glad, stocks have gone up a little bit lately. So it's a little easier. It's a little more fun to talk
Yes.
about this stuff than about 2 weeks ago.
Right. I kind of helped you out there. I drug my feet in doing this. So, give you a little green space to work in.
Thank you.
So, we're going to do a quick little Q4 market update for all my people. So, I have a couple questions I'm going to run through with you. Number one, the markets were, as you mentioned, a little tough running from August, September, October. What caused that pullback, and what were the main catalysts of that?
Yeah, I mean, Steve, there's a few ways to look at this. Let's look at it this way. Let's look at the positive first. At the middle of the year, the S&P was up over 20%. That was the best actually 7 months. That was the first 7 months of the year. S&P is up 20%. The best first 7 months for any time for the S&P going back to 1997. It was the best first 6 months ever for the NASDAQ. So we can talk about some of the very clear concerns that we've all seen on TV and hear about every day. But I think some of it is as simple as, listen, we had a great start to the year. August, September historically can be a little potentially troublesome. Even the first half of October can be, and that's exactly where things played out, right? We had about a 10% correction on the S&P 500. Now we know the worries, right? Yields continue to move higher. Concerns about the economy, the terrible war that obviously has started in the Middle East. All these things swirling together helped kind of cause, if you want to say it that way, stocks to pull back. But I'll be honest, Steve, I think it was simply we've had a lot of bad years. I don't want to put it like that. We've had a lot of years with a lot of bad news with still higher gains, right? This year, stocks are up pretty nicely, honestly, all things considered, with some pretty bad headlines that are out there. I think it's sometimes just stocks need a break. And honestly, for whatever reason, the third quarter historically is when that takes place. Well, Mark Twain said history doesn't repeat itself, but it often rhymes. I've used that a lot.
Mhm.
It rhymed. And if it's going to keep rhyming, maybe we're going to have a good fourth quarter. That's what I think is going to happen here.
Perfect. And that's kind of leading right into my next question. So, we've had a lot of talk about a possible year-end rally. It sounds like you still think that could be possible. And what are some key indicators to kind of look for to make that come to fruition?
Yeah, I think there's two things I'd like to focus on. We'll start with, can I use the F word, Steve? Is that okay? The Fed? Is that okay if I use
Okay.
the F word? Yeah, see, got you, didn't I? I know, sorry. Anyway, it's my joke I use. The
Yeah.
Fed and earnings. We're going to focus on these two real quickly here. So we'll start with the Fed. The Fed, as everyone knows, hiked interest rates aggressively. 11 hikes in a row, 500 basis points. Let's just keep it simple. That upset the apple cart. They did that to slow inflation down, right? That's why they did it, to slow the economy down, slow inflation down. Steve, we're optimistic the Fed is done hiking, right? The market's actually kind of buying that also when you look at geeky things like Fed funds futures. Let's just keep it at, we think the Fed is done hiking. That was a headwind before, going to be a tailwind as we move into the future as inflation continues to kind of come back down. Supply chains have opened up, a lot more positives out there. So that's one of the positives. Honestly, that's a big reason we had such a big rally just recently, as the Fed is viewed as, they might be done. The other one, though, the economy, earnings. I mean, earnings next year in the S&P 500 are expected to hit an all-time high. And I know that's estimates, and believe me, I know that can change. But corporate America continues to have really strong balance sheets. Consumers, there's some cracks with consumers, but no major shakes under the foundation. Consumers still healthy. We're still making between 150, 250,000 jobs every single month. The economy's still moving. So if earnings continue to surprise the upside, Steve, like we think they can, strong earnings and a dovish Fed are two drivers for the rest of this year. But I'll be honest, probably in the next year as well.
I love it. That's perfect. And so that you keep just kind of teeing yourself up for the next question. So, my next question was, what's the deal with the Fed these days, right? Like, came out a little while ago and they're like, oh, we're going to hike, which kind of caught us all by surprise a little bit. Since then, they've changed their rhetoric. So, I think you answered this already. You don't see a hike between now and the end of the year, at least in your estimates, correct?
Yeah, yeah. Sorry for kind of giving a preview already here, but no, we don't. I kind of take a little different angle on the Fed here. Let's just be very clear. The Fed is very powerful. Does it mean they're all knowing? Does it mean they're always right? Short answer is no. If I remember that word transitory, the Fed kept saying inflation's transitory. Inflation's transitory. Then we realized inflation spiked up over 9% year over year, and the Fed's like, got an egg on their face, kind of said, oh, our bad. Then they hiked rates super, super fast, probably way too fast. And honestly, they should have started hiking before. Believe me, maybe some armchair quarterback there, but a lot of people think that. all I'm getting at is now the Fed is kind of realizing, inflation's coming back down. Steve, shelter, right? So like rents and housing, that makes up like 40% of core CPI. So that's a lot, okay? And the CPI is consumer price index, so prices of things. So if rents have been up here for a long time, they're starting to slow down and kind of come back to earth is maybe a better way to put that. That's a big part of inflation. Used cars, remember everybody? They're like
Hmm.
40% year over year. Oh, I don't know, this time maybe a year or so ago. Used car prices are drastically coming back down also. So what I'm getting at, inflation's coming back down. The Fed's never going to come out and say this. The Fed likes to make it confusing. Every time they talk, you don't know what they're really saying. But the Fed, they're looking at the same data we are. Inflation is really coming back, Steve. That's a positive. Productivity has really been strong lately. Keep this real high level and simple. When productivity is high, like we saw in the mid 90s, you can have higher wages, you can have economic growth, you can have strong profits, but you know what? You do not have higher inflation. We saw that in the mid 90s. I'll tell you, Steve, there are some real similarities between right now and the mid 90s. And for those of you with your history books out, the mid 90s was a really solid time for the economy and a really solid time for the stock market for several years. So productivity's high. That's a real good thing. And it could say, hey, the Fed take their foot off the pedal, and who knows, maybe even cut a time or two next year, which we think the market will really like.
Yeah, and that's again, I love this. You're kind of just going into my next question of, where do you see rates kind of a year from now, right? Like it sounds like there could be some cuts on the table. I know there's the world interest rate probability index that's out there and some of these other economic indicators, but what do you guys think? Where do you think rates will be this time next year?
Yeah, so let's just be clear. We've been in the higher for longer camp. What in the world does that mean? Well, that the Fed wasn't just going to start cutting right away. I mean, back in March, when we had the regional bank crisis, a lot of people said, hey, the Fed's going to start cutting, right, to revive the
Mhm.
economy, to fix things from that regional bank crisis. It was obviously a very big deal there back in March. But going forward, we think the Fed will leave rates where they are now. Maybe the second half of next year, though, they might cut a couple times. And again, in 1994, Steve, the Fed hiked rates aggressively. Bonds had a really poor year. Stock market didn't do all that well. Economy was kind of teetering on recession, actually. They had one more hike in February of 1995. Then they stopped. And then they actually started cutting in late 95 and into 96. Again, as productivity was high, the economy was growing, wages were strong. A lot of these similarities is right now. So, one final concept on this, let's say the Fed does cut maybe in the middle of next year, give or take. The market's going to sniff that out. And when I say the market, I'm talking yields. I'm talking the 10-year yield, I'm talking mortgage rates, the stuff that you hear about all the time on TV. If that's coming, and it could be, I mean, yields have had a significant drop just recently, right? As people are
Mhm.
sniffing out the Fed's probably done hiking. So those are things we're going to watch. But again, one final thing. I think all your clients need to know this. Last couple times the Fed cut, what happened? 100-year pandemic, the Fed cut. It wasn't good. The
Mhm.
financial crisis, the Fed cut rates. It wasn't good. The Fed cut rates in 2000, the tech bubble. It wasn't good. I mean, stocks are now 50%, and about 35%. Not good times. We have short-term memories. We're creatures of habit. If you go back looking further back, everybody, though, the Fed has cut before and things have been just fine. It's because when productivity is higher and the economy is a little stronger, Steve, that's where we think we are. We think next year they might cut and it's not going to be a really bad scenario like the last three times they cut. So I'll come on with you in about another month or another quarter or so. We can talk about it again to make sure I'm right. But that's how we see things
Perfect.
looking right now.
Beautiful. Awesome. I love it. Last question. So, you know, I love that you guys, beginning of the year, you were the contrarian call, right? Like you came out and were very vocal saying you don't see a recession this year. The odds of that were coming out very low. The word recession is still resonating in a lot of my clients' minds. The media is still selling that story because, hey, it sells, right? Where do you think we are for a possible recession going into 24?
Yeah, that's true. I mean, a year ago, we were saying no recession, and people hated that call. I don't know why.
Yeah.
We were optimistic. People were mad. I mean, we said, hey, stocks might gain like, 12 to 15% this year. That's what we were saying a year ago. People were mad when they heard that. And
Hmm.
it's kind of played out, and that's fine with me. It's how it goes, I guess. But we're still optimistic there's not going to be a recession next year. Now, we like to put percentages on things. We'd say there's
Hmm.
about a 25% chance, Steve, of a recession. So it's not our base case next year. We're very clear. But there's always, some potential or something can happen. But the way we're looking at the world, we're positioning, the money that we run, we're looking at a world that does not have a recession next year. And again, that's being led by strong profits, being led by a strong consumer. Housing, which is obviously with higher rates, it's really hurt the housing market. But if rates start to come lower, housing's kind of that thing, the economy on steroids. That can be a tailwind. I'll tell you, last thing, manufacturing. Manufacturing surveys have been, weak, potentially saying a recession. But if you look at the hard data, things like durable goods and industrial production, Steve, manufacturing is actually on pretty good footing. So that's kind of like that canary in the coal mine. So again, to us, there's just more reasons to think we've had a slowdown. Yes, not a recession. One final comment on all this stuff. You're going to hear about how the economy's slowing, and there's some truth to that. To us, though, it's more normalizing. We cannot grow at 400 to 500,000 jobs every month like we did last month. That's just not, or last year, apologies. That's just not sustainable. A lot of other things are kind of coming back to earth like that. So again, we think we're more normalizing here in the economy, and that could be a good thing. We still might see, 2.5%, 3% GDP growth next year, which is still above the 10 years before COVID, and profits can be strong as well. So all in all, odds are no recession, and we still think this bull market that started in October of 22, we still think it's got some tricks up his sleeve.
I love it. As always, thank you so much for your time. We'll definitely check in with you in a few months and see where everything's at. But again, thank you. I appreciate the insight, bud.
Honored to be here. Thanks for having me back.